The dollar-yen pair could be a pain trade in 2024, and here is why. Hi, I'm Jean, a researcher at The Expert, and welcome back to another episode of our weekly sharing. Let's get right into it. A few months ago, the BOJ board showed a hawkish tilt in its October meeting summary, steering towards a good BOJ policy direction. However, now that we're already in January, the Japanese yen continues to be weighed down by the fact that the chances for the Bank of Japan to end its negative rate policy have faded in the wake of domestic factors, like Japan's recent devastating earthquake, falling rates of inflation, as well as its weak wage data. It is weakly anticipated that there will be any changes in the upcoming meeting on the 23rd of January, that there will be any policy action from the BOJ. One thing is clear though, the spring wage negotiations will be extremely crucial and could have a significant market impact on both its yield curve control timing as well as rate hikes. On the other hand, in the Fed's Governor Christopher Waller's acknowledgement that rate cuts are likely this year, the central bank can take its time relaxing monetary policy, which seemed to counter market anticipation for aggressive easing this year. Meanwhile, the prospects for a less aggressive easing by the US central bank remain supportive of elevated US Treasury bond yields. The resultant widening of the US-Japan rate differential turns out to be another factor undermining the JPY. Actually, it's a rather important factor. As we all know, Treasury yields have a great influence on currency prices, especially when making decisions relating to currency trading. In this case, the importance of assessing the dollar-yen outlook based on current and expected yield differentials between the US and Japan is supported by recent market trends. Despite a 7.2% decline in the dollar-yen pair in the fourth quarter, driven by shrinking yield differentials, this occurred despite a strong return of risk appetite. Normally, such increased risk appetite would be associated with a likely rise in the dollar-yen exchange rate. This view is further proven consistent with the findings from Bloomberg Beta Correlation Function, which showed that the weekly correlation between the dollar-yen and the US-Japan 2-year yield differential is strong at 63%, in contrast to a weaker negative correlation of 17% between the S&P 500 and the dollar-yen. If we look at the market sentiment for yen positioning, non-commercial net positions have actually rose. However, the expansion of long speculated yen positions serve as an indirect sign of heightened activity in the yen market. Nevertheless, its impact on the price is not direct, given the limited data volume it represents in comparison to a global scale. Now let's look at it deeper. Leveraged funds have reduced their yen holdings, while asset managers with a better grasp of midterm market sentiment have recently increased their yen exposure as indicated by CFTC data. This mirrors the prevailing bullish yen sentiment. The persistent short positions on the yen by leveraged funds align with the recent rebound in dollar-yen, underscoring the possibility of heightened bullish yen movements in response to a triggering event. As of January 5th, leveraged funds contracts on the yen stood at minus 61,995 versus minus 12,806 on January 3rd last year, and asset management's at plus 24,198 versus minus 16,265. As for rates expectations, the BOJ is expected to start hiking rates by year-end, at a time when the Fed is expected to have already cut rates by 125 BPS. The US dollar remains well supported by reduced bets for a March rate cut by the Fed and provides an additional boost to the dollar-yen pair. In summary, if you were to trade the dollar-yen pair, do pay attention to the release data of Japan's spring wage negotiations and the yield difference between the US and Japan. At the meantime, you can look forward to US economic docket featuring the release of manufacturing as well as services PMI figures for short-term trading opportunities. That marks the end of the video today. Thank you for tuning in. Subscribe, share, and like this video if you enjoyed it. As always, happy trading and see you in the next one.